The oldest of the baby boomers, by law, now have to sell their assets that they have accumulated in their retirement accounts. This is a law. This is a government-mandated stock market crash that has to happen. Hi, this is Mike Maloney, and I wanted to talk about one of the major factors that is going to determine the trends of the stock market and the trend of the economy in the future, and it's going to affect everybody's life very deeply. And in this article that was just published on Zero Hedge, John Rubino talks about two trends that will force the Fed to start buying stocks. Now, I'm not as concerned about that, but when you get down to the second trend here, he talks about something called the ERISA Act. He says, at age 70 and a half years old, retirees are mandated by force of law to sell their tax-deferred assets accumulated over their lifetime and to do so in a 15-year period. Conversely, buyers, incented by tax deferral, but not by force of law, generally have a 35-year window of accumulation, so they're buying all of the assets for their retirement account over a 35-year period. Over the past 65 years on a population basis, there were 3 new buyers of stocks for every new seller of stocks. That's one of the things that causes markets to go up, is if there's more buyers than sellers. Over the next 25 years, on a population basis, there will be 3 new sellers for every new buyer. This means that the stock markets have to go down. Now, I've been talking about this. I first started talking about and presenting information on this back in 2007, so it's been a decade now for me. It's in my book, but what he's talking about here is the ERISA Act, and that's the Employee Retirement Income Security Act of 1974. And what this did, this was the act that created the individual retirement account and the 401k. This created the ability to defer taxes. You can use pre-tax income to invest in stocks and mutual funds and so on within your IRA account. And so you're not paying any tax on that currency that you made, that income that you made. You get to invest it before taxes. But eventually, the government wants their pound of flesh. They want taxes on it. So you invest pre-tax currency, and then when you sell, they want their taxes. So you're going to pay taxes on it eventually. It's just that you invest it pre-tax. When you liquidate it, then you pay the taxes. And to make sure that they get their taxes, they force you to sell. At age 70 and a half, you have to start selling. You have to sell a certain percentage of your individual retirement account every year. And that means that eventually there will be more sellers than buyers. This is by law. And this finally took effect just last year. The oldest of the baby boomers, by law, now have to sell their assets that they have accumulated in their retirement accounts. And every year, there's more and more and more baby boomers that fall into this category of sellers from now on. And this is going to be happening and getting worse and worse over the next 15 to 18 years. This is a law. This is a government-mandated stock market crash that has to happen. And, something that's interesting, I've been following a guy named Carl Swenlin for some time of DecisionPoint.com. And one of the articles that Carl wrote recently, I've had it bookmarked since February. I've been sitting on this article and I haven't presented it yet, so now I get to show it to you. But the stock markets have been going up. This is the Wilshire 5000. So you're talking about a very, very broad measure of the stock market. And it's been going up, yet if you take a look at the total assets of mutual funds, there have been, this is inflows into mutual funds, and these are outflows. And you can see that pretty much, except for the long-term capital management crisis of 1998 and the Russian default, and then the crash of 2000, at the bottom of the crash, people sold and got out. The crash of 2008, at the bottom of the crash, people sold and got out. Retail investors, the small investor, tends to do things at the wrong time. They pile in and they really buy right at the top, and then they sell at the bottom and take losses. Now, in this last rally since 2009, we've seen every time there's a little pullback, people used to be sort of panicky. Every time there'd be a little pullback, small investors would sell. But now we've been having a rising stock market, but for the past couple of years here, there have been sales going on. There's been more outflows of mutual funds than inflows. And that's a bad sign. It says that that slack, all this upward momentum is coming from somewhere else other than the small investor investing in mutual funds. And this is it's a primary trend caused by simple demographics, age demographics. And I go into this in quite a bit of depth in my last 2 episodes of Hidden Secrets of Money. Episode number 6 presents all the information of why there's going to be a deflationary recession coming and a large crash. And then episode number 7 sort of shows you what the results will be. So please take a look at these videos if you haven't watched them already. So anyway, if you got anything from all of this, please like this video, share it, and subscribe to our channel. Thank you very much. We'll see you next time.